Higher for longer, potentially 5% yields. How does that impact you and your company? You're known as our resident dividend investor. Does that change the thesis on dividend investing?
No, not at all. And it really is because of that inflation component, right? So that 5% sounds really great superficially, but it sounds a lot better when you only have 2% inflation. Right now, CPI is at 3.7. So your real rate of return on that 5% treasury is only 1.3%. And if you buy a treasury bond and you're getting 5% and you're holding it until maturity, so your yield to maturity is 5%, that is all you're getting. And the coupon, the yield to maturity, isn't going to grow. Whereas on dividend stocks, the average growth of the dividend stocks over the past 70 years has been about 5.7%. Sorry, the average growth on the dividends of dividend stocks is 5.7. So not only do you have potential capital appreciation because they're stocks on the share price, but you actually have the dividend growing, so that more than outpaces inflation in a really important way.
All right, so even during higher for wait, so Jenny, even in higher for longer, you're still bullish on dividend stocks. I do want to go over to Gordon.
Even more so.
Okay, even more so. So Gordon, over to you. I know you're very active on the options market, specifically short selling. If we see this higher for longer environment continue, yields getting up to 5%, what sectors are you looking at least for when it comes to options?
Right, so we're very negative right now on solar. And very simplistically, the bulk of solar, whether it's on your rooftop or in a utility field, is funded with debt, right? So the cost of debt has skyrocketed higher. And as a result of that, demand for solar has collapsed. How do we know this? The solar TAN index is down 33% year to date. As Bob just said, S&P up 13% year to date. But specifically, the stock we're looking at, the recommendation we're making today is to short a company by the name of SolarEdge, Sedge. The reason is because you've already had a major inverter player, Tygo, come out and negatively guide revenue. Revenue down, their guidance they cut by 58%. And you're seeing this big decline in solar demand. So we think the solar stocks are going to get hit. They already have, but we think it's going to get worse this year.
All right, I want to bounce something off both of you. Bank of America just put out some research just a short time ago saying that if yields stay stable below 5%, the S&P can avoid what they call a big drop. They say the bottom is essentially 4,200 if those yields stay below 5%. Jenny, back over to you. Agree or disagree with this thesis from B of A?
I agree with that. And that's kind of just a simple math equation where you take, okay, here's what's expected earnings for next year, call it 247, 250-ish. You put a current multiple on that. That brings you to that level. You've got maybe like a, I don't know, 1.5%, 2% band around it. So that's not really that audacious a call. It's just kind of simple math.
Fair enough. Gordon, same question for you. Just to keep it in perspective for the viewers right now, 4,200 would be about a 4% drop from where we are right now. So Bank of America basically saying if yields are below 5%, that gives us downside protection down to about 4,200 as support.
Right. So I just don't think that's going to be the case. I think yields are headed higher. Look, CPI inflation on a month-over-month basis is now up 3 months in a row. And keep in mind, Frank, as you know, that healthcare adjustment they did last year, right, where healthcare costs in the month of September were down like 38%, right? That's not reality. That's because of a clerical adjustment. That headwind to inflation becomes a tailwind starting in October. So I think that because inflation's headed back up, rates are going to go back up. I also think the bond vigilantes are back. So I think the Fed is losing a bit of control here.
All right, the bond vigilantes. Okay, that's interesting. So Gordon, if you think we definitely are going up to 5%, I know you have another sector that you're looking at to short once again. And again, shorting is a big part of your thesis for your company and how you actually generate a lot of your revenue, right?
Well, we're not just focused on shorts, but we think there's a lot of good shorts. So the EV sector, just broadly the EV sector. Last year, prices of automobiles in the U.S. up 8%. Year to date this year, down 0.3%. Why? Because you've had a bunch of new companies spring up out of nowhere because capital was effectively free, 2020, 2022. So it's simply supply demand. You have a lot more cars, same demand. You're having price wars. We're seeing that reflected. We think that's going to be reflected in earnings. We think the EV stocks are going to come under pressure writ large.
Jenny, I'm going to give you the last word. I know you're looking at this higher for longer. I also saw you shake your head a little bit when Gordon says he thinks rates are going up above 5%. So you also have some picks for us. So what's your take on the environment right now?
So that's where I disagree with Gordon, although I love his short EV play so much I can't stand it. So So where I think we are is we're at 5%, and then I'm looking at it, I'm looking at it and saying, okay, are we steady from here? Are we plunging? Are we fading? Are we going up? We actually think it's 5% and fading, and it might be kind of like a steady but a fade. And so we think that's because the Fed is done tightening. Yes, they're rolling off their balance sheet, but we don't think that rates go up much higher from here. So in that environment where it's 5% and fading, but that 5% is because of inflation. It's not because of economic growth behind that. It's because of crazy drunken sailor government spending. Then we like companies that are low multiples, high degree of economic certainty, growth, and we like Organon, Cisco, Ventas, United Rentals. Some of them have been punished because of leverage. We think that doesn't actually hurt them. They all have really low multiples, really steady, really predictable earnings growth that's agnostic of the broader economic environment.